Good morning, everyone, and welcome to our webinar, Crack the Code, Effortlessly Quoting Life, Long-Term Care, and Hybrid Policies with Regional Marketing Director Derek Lape. This is Jordan, the Marketing Coordinator here at AIM. Today's webinar will be recorded and then later posted on our website. This does mean that all attendees will be automatically muted so that we get a quality recording. If you have any questions, go ahead and type them into the chat box and we'll try to answer them throughout the presentation. But if we're unable to get to all the questions, we'll have a member of our marketing team reach out to you individually to make sure you get that answered. Before we get started, we'd like to invite you to join us for our next webinar on Tuesday, March 18th at 9 a.m. Pacific Time. Join AIM's Mike Anderson and Life Secure's Eben Marsh for Long-Term Care's Untapped Goldmine. And with that, I'll hand it over to Derek so that we can go ahead and get started. Take it away, Derek.
Thank you, Jordan. Hello, everybody. Welcome. As Jordan already kind of announced the title of what we're doing here. So basically, what we're going to go through today is going to be kind of a progression. We'll start from really the most simple to kind of the more complicated. I don't like to say easiest to hardest because none of this really has to be hard. One thing I'm sure a lot of you guys have heard me say, if you've been on the phone with me and I'm walking you through, especially IUL quotes, is you can really make them as easy or complicated as you want, right? There's a lot of different moving pieces, or you can keep it very simplified. So with that, we're going to kind of start with more of the actual beginning of the process. We're going to go through, whether you want to call it a role play or a real play. I've heard it called a few different, terms depending on where I was working, but kind of just a quick run through of what the conversation process could look like to help, simplify what you're doing when you're talking to people, as well as making sure you're not really leaving anything on the table. So it's going to help you get a little bit more out of what you're doing in your processes. From there, there's going to be obviously keywords and phrases you're going to look for, and then we'll start jumping into the quoting itself with some of the different softwares, programs, some of the things to look for, what some of the terms on those quoting softwares actually mean, and really kind of what you have to adjust and what you could probably get away with just leaving alone. So it's going to be a bit of a journey. We'll try and squeeze all this in, into under 40 minutes. Any one of these subjects could take over that amount of time by itself. So we're gonna power through this a little bit. So when it comes to that initial conversation, right, a lot of times, whether it's agents calling out on leads or you get someone who's called into your office because they got a referral, whatever the case is, right, they'll call in and they'll say, hey, I need term insurance. I've worked with a lot of agents. I've seen a lot of agents. They will take that at its face value. They will say perfect, and they will go ahead and write up a term life policy and not really dig into anything else and really see if that's even the best product for the client and their needs, and it's going to really accomplish what they need. So for me, each conversation is really a case-by-case basis, right? There's going to be some things you're going to do that are going to be very similar or even the same in each conversation you have, as far as leading the conversation, using open-ended questions to try and find more information, close-ended questions to steer the conversation a certain way, right? But it's going to be a little bit different every time. With that, some of the things that are going to be the same is you always really want to build that you are the insurance professional. You know what's going on. You know what you're talking about. There's a reason they came to you. You also really want to add your value. And by that, I mean, find out not only what's going to differentiate you from other agents who, this potential client might be talking to and hearing from, but really how you're relevant to the client, right? I'm able to meet you after your work hours. These other agents aren't meeting her needs there. Or I'm able to really explain this product in depth. You'd be surprised how many agents don't do that. And I've gotten business just based off the fact that I took the time to really explain life insurance, especially when it comes to IULs, because there are so many moving parts. And that's one product where a lot of agents will just skim through because they don't completely always understand everything themselves. And it's part of the reason why so many people don't touch them, even though they can be very, very simple, right? And then with that, there's going to be keywords and phrases, certain things that you're really looking for in the conversation that are going to really help you decide whether or not, okay, this person knows exactly what they're talking about. They're right. They do just need term life insurance. Or maybe when you're going through this conversation, they need some kind of permanent life insurance. Maybe they need a mixture of both, right? And then once you figure that out, which is probably going to be, a quarter or halfway into the conversation you're having, you can start to lead them to that conclusion as well. It's a lot easier to close on something when the person, has the same idea in mind, right? When they're thinking, oh, wow, I really need that product. And that's kind of where this conversation is going to come in, where you're going to get through stuff a little bit easier, and it's going to really start to simplify stuff. And even though there are certain things you're doing pretty much identical every time, it's going to be customizable. You're going to be able to switch things, right? And you're going to hear that in this, kind of conversation that Jordan and I are going to have, where you'll see this may not be the most polished conversation, right? It may be a little bit quick and dry. In real life, I'd probably add, more of my personality in some places, such as humor that there, or, getting a little bit more personable on some of the level, talking a bit more about kids or pets, whatever the case is, right? But for this demonstration, obviously, I don't want to have, an hour conversation going into imaginary kids and dogs and stuff like that. So kind of keep that in mind, right? Look at the key factors we're trying to get out of this. And then from there, put your own personality into it, put your own spin on it, right? I'm sure a lot of you guys, especially as existing agents who are successful, is doing this, just without even thinking about it. But it's a good thing to kind of revisit every now and then and make some tweaks and just kind of try some stuff out, right? Maybe, the last time you had a conversation, you tried something this way. So you want to tweak it on the next few people and see if that gives you better results on closing or, pivoting or whatever the case is. But it's always a nice kind of fun way to tweak stuff here and there and just see what the results are. But with that, Jordan and I are going to go ahead and kind of jump into this conversation. Neither of us are professional actors, so don't judge us on our ability to kind of go through there, but just kind of listen and kind of see where you would go with what product recommendation or as far as the solution to what, this client's looking for. And kind of just jot that down if you want to and see if we kind of land in the same spot, right? And if the products that I'm going to kind of think, okay, this is what they need, are the same that you think. So it's a fun kind of exercise to do. But with that, we'll go ahead. I'll bring Jordan on. Jordan, are you ready?
Mhm.
Okay, perfect. So we're just going to start off with the phone ringing. Obviously, I'm giving her a call. Ring, ring.
Hello.
Hey, Jordan, this is Derek with Derek's Insurance. How's your day going?
Hey, Derek. I'm good. Just been running around with the kids all day. Got to pick them up soon. How about you?
I'm great. Thanks for asking. So what got you thinking about life insurance?
I saw something on Instagram about how important it is and figured we should have something in place.
Social media can be fun, can it? Well, I have to give you credit, though. I mean, a lot of people really put off life insurance until it's too late or a lot more expensive. Have you and Tom seriously looked into life insurance before, or is this your first deep dive into it?
This is our first real look into it.
Perfect. Well, part of my job here is to make everything as easy and seamless as possible, as well as making sure we're finding the right protection for you and your family. What's your biggest concern, right? Is it covering expenses, providing for the kids, or something else?
Really just making sure we can keep up with the bills and that the kids are taken care of if something ever happens to one of us.
That makes perfect sense. So how many little ones do you have and how old are they?
2. So Donnie is 4 and Nisha is 2.
Awesome. I bet they keep you super busy. Are you the primary caregiver?
Yes, I stay home with them full time and my mom helps when she can.
That's great you have support. Do you plan on staying at home, or do you want to go back to work once they're in school? Have you guys thought about that?
I'd li- I'd like to go back into teaching once they're both in school.
Okay. So is it safe to say that right now Tom's kind of the primary income earner?
Yes. He's an accountant, so he makes about
Okay. Perfect.
150K a year.
Awesome. That's a great profession to be in. If something happened to Tom, what would be your biggest financial concern right now?
Probably keeping up with the mortgage and the bills, and childcare would be a big issue too.
That's a pretty common worry amongst families. Is there, have you guys kind of thought about if Tom wasn't able to provide anymore, how long your current savings or financial situation might last for?
Probably just a few months.
That's actually really common, right? A lot of families are in that same position. Do you guys have any life insurance or, disability coverage through work?
No, we really just have our savings.
Okay. So as far as financial commitments, right? Do you guys have any mortgages, car payments, other major debts?
Yeah, so we just bought a house and we still have car payments and some credit cards and student loans too.
Okay. If Tom wasn't able to provide anymore, so I know this is kind of hard to think about. Some of these questions are going to get a bit personal, but if something happened to Tom and he was no longer there, right, and you had to go back to teaching, do you think you'd be able to cover all those bills and, finances with just your teaching salary?
Not at all. I'd only be making around 50K a year.
That would be a big gap to overcome. Let's switch gears a little bit right here. So, how familiar are you with, the difference between the different types of life insurance out there? So, term life insurance, permanent life insurance.
Not super familiar. I just know what I saw on Instagram.
Yeah, no worries. So there's really two different types. There's the terms, which is kind of what you called about when you first called in and we set up this meeting. Really, it's just set for X amount of years. So whether it's 10, 20, 30 years, right? After that, the premiums can kind of do whatever they want. Usually means it's going to jump up a big, chunk. And then there's permanent life insurance, something that's going to be, pretty much set in stone as far as the premium goes. It's always going to be there for you. The pros and cons are the term insurance, as far as death benefit, gives you a little bit more for your money, right? So what you pay in for the premium gives you a bigger benefit. The permanent life insurance, obviously, is it's always going to be there. With that, it is a little bit more expensive, but it's something that really, ensures that you're going to have protection for you and your family for, you know, as long as you guys are going to need it. And there's also some fun, different things we can do with that, right? So, for instance, I've made them as college savings plans for children to mimic annuities or just simply for life insurance. Does kind of any of those sound interesting to you?
The permanent one sounds interesting, but we need a lot of coverage right now.
Yeah, that's probably a really good point, especially with the mortgage and different things there. One thing a lot of families do to keep the cost down and make sure they're able to, you know, cover all those debts and things they have in place now, as well as have insurance in the future, is they'll do a mix. So they'll get, a bigger term policy now, and then that'll, kind of go away after 30 years. They'll let the policy just cancel when it's going to be out of its term. And then they'll have a smaller permanent life insurance policy in place after that. That's continued this whole time. So that's one approach that's pretty common. Would that kind of be one that might fit for you?
Yeah, that actually sounds pretty smart.
Yeah, perfect. And it's just one of the things where it makes it a little bit easier to tailor an option specifically for you guys. From here, what I'd really like to do is kind of just put together some different options and go over them with both you and Tom at the same time and see what really makes sense for both of you. But while I'm doing that, do you guys have any kind of budget in mind for what you're really looking to, spend each month?
I think we could do around $500 a month pretty easily.
Okay, sounds perfect. So I'll get some stuff put together. We'll kind of go through and make sure it's in line with what you guys are really hoping to get out of it as far as coverage, benefits, the length of the policies. Make sure you're comfortable with that. Would tomorrow around 5 work for you and Tom?
Yeah, that works great for us.
Perfect. Well, I'll get everything worked up, and from there, we'll just kind of sit down and go through it. And I look forward to talking to you guys tomorrow. All right. So, thanks, Jordan. So, obviously, this wasn't the most polished approach, right? It's one of those things with role plays, real plays, whatever you guys want to call them, right? Where it's a little bit more awkward to go through something that's fake and kind of forced, but it's good because you can start to throw in different scenarios for different things and kind of see how you would address it. And it kind of becomes muscle memory when you're going through it. Part of the keywords and phrases that I usually look for, and whether you structure that kind of whole meeting the way I did there, in all reality, that's probably not exactly how I would do it in real life, right? But there are key things you really want to look for in every conversation. And that's going to be, is there a budget, right? So whether you're calling in to have us work quotes up for you or you're going to do these quotes by yourself, it's going to make your life a lot easier if you know they have X amount of dollars to work with. You can come back from, not having a budget and just presenting stuff. But if you present something and let's say someone's budget is $300 a month and the plan that you come forward with is $1,000, right? They may not necessarily say, holy cow, that's too much money. We can never afford that. They may just kind of blow you off. And they may never stop to actually look at there's a lot more affordable options for them. With that, some people aren't going to give you a budget, right? So you kind of have to just have some different middle options that you're going to be really clear about of, hey, let's not fixate on the price right now. There's a lot of things we can do to adjust this to make it more budget friendly, to get more coverage, just a lot of different options for what you can do. The other things that are going to be really important are why they're looking into it, right? What are they worried about? What has them actually looking into life insurance? The reason for that is it's going to be a lot easier to lead them to the product or the solution for those kind of fears and worries when you know what it is, right? So it's going to help you cut out a lot of the objections you'll get, and it's going to be a lot easier to get them to jump on board. I don't know about you guys, but for myself, and this is going to sound horrible, but I like ideas a lot better when they come from me usually than a perfect stranger I've never met, right? So if the perfect stranger's kind of pushing the idea I came to in my head, the conclusion, I'm like, I need this, it's going to be a lot easier for me to sign up and do it, right? One thing with all this is you are the professional, right? You know so much more about this than they learned on social media or than they can find out Googling. So probably about a quarter of the way through this conversation, you realize that they have kids, right? They have mortgages. There's only one income coming into the household. So if something happens there, that's going to put them in a dire situation, right? And you're kind of able to go from there, right? And you're able to kind of lead the conversation to get to that point. So those are going to be really big things to look at. Obviously, that's why debts are on there. Another thing is what they're really hoping to get out of it, right? You may have someone call in who wants an index universal life or a long-term care policy, not just because they need life insurance. They may have saw one of those videos on Instagram or, any other social media platform of how, the top 1% are using life insurance to, pass down, generational wealth and get around taxes and or use it to grow money, right? So there's a lot of different options there. And if you don't know really what they're hoping to get out of it, it's going to be a lot harder to sell it or build the right kind of policy for them, right? You're not going to be able to offer that solution that they really need, right? So there's a lot of different things there. One thing that I didn't get in that conversation right? I'm not perfect by any means, but that is very important and helpful to get if you can, is going to be their health. One thing I do is whenever I'm doing quotes, I always do it at, the standard select rate, whatever you want to call it, just because it's a lot easier to come back if they do get issued at preferred and say, hey, great news, your premium dropped, versus if I quote them at preferred and it goes up to select or standard, it's a lot harder conversation to be like, hey, your premium went up, right? A lot of times they'll still get it. It's not impossible to save that sale. It's, a lot of times pretty easy, especially if you did the groundwork and let them know that this is based off of how you're going to qualify health-wise and different things like that. But it is a tougher kind of battle, right? You're rowing up the creek instead of just, gently floating down it. So it's one of those things where health is going to be a good one to get. With that, we do have kind of these pre-health, pre-screen questionnaires that we can send you guys if you want them. They're not going to go super, super in depth on every medical condition this client's ever had, but it'll get a lot of the big red flags that might pop up out of the way. And then if you see something on there you're not sure about, you just reach out to us. We can get it off to, kind of get it pre-qualified. Obviously, that's not 100%. Yeah, we're going to issue this, but it's going to give you a good idea. So that way you're not going through all this on a certain product that's not going to get issued, right? You can either say, hey, this isn't going to fit, but I do have some other stuff that will, and go ahead and pivot to those. Or unfortunately, right, there's just nothing we can do. So it'll save you from putting a lot of time into something that's not going to work. But this is kind of why, for me and a lot of agents who I've seen really be successful, it's more of a fact-finding mission, right? Every time you have these conversations, whether they call in and say they just want term life insurance, the more information you can get, especially with these keywords and phrases, the easier it's going to be to build the right quote. It's going to make your life a lot easier to close on the deal. And it's going to make the quoting process quicker because you're going to know exactly what you're building. And then you don't have to go in there and build 20 different quotes to try and cover every angle that this person might be thinking, right? Which isn't a great approach either, because if you throw too much at them, it's just going to overwhelm them, right? So you really only want to have maybe 2-3 quotes max, right, of different options and avenues to go. And really, you should already know, especially if you get this information, what the best answer for them is going to be. So you really just need to help get them to that conclusion. All right. So with that, we're going to jump into the reason why a lot of you guys are actually here, right? It's quote time. So I'm not going to actually quote Jordan, right, or the fake Jordan we had in this kind of role play, just because she's young, it's easy to go through, right? And that's not going to make much sense for a long-term care. So like I said, we're going to start with kind of the easiest. With that, this is a quoting software that we developed, for mutual, right, care, their custom quotes. It's something that you can have on your desktop. It's pretty easy. It looks like this little gear cog down here at the bottom. When you click on it, it comes to this page. It'll open up. If you guys don't have this and you do have long-term care with mutual, reach out to us. We can send you this, right? You can download it, get it pretty easy. You'll go ahead and click on this 3.92, and that's going to be the newest one, and it's going to bring you into here. So with everything we go through today, there are going to be some slight differences based off of state specifics. Certain states don't let you do certain things, so keep that in mind. One nice thing with pretty much every software we're going to go through today, they're pretty user-friendly. So if you're trying to do something that you can't do in a state, it's going to throw up a flag. It's not even going to give you the option to do it, right? They make it pretty, user-friendly. All right, so to start with, you're really just going to want to throw in the client's name. Down here right below that is going to be the agent name. So that's obviously going to be you. In this case, just put my name, Derek. The full name is going to be valued client. One thing I like to point out, so especially when using this tool, is when you look at the client, it looks like there's a little guy here that's male and below it a little female. So something I've seen some agents do is they'll put the name if they have, a male and the male, and then put a female name and the female, even when it's just one client. Really, you just want to put, if you have one client, right here. The reason for that is over here in this upper middle, and I know it's kind of hard to follow this arrow, you actually have the gender sex that you can change. So it doesn't matter if it's, a female or a male in that first line, even though it looks like it's just supposed to be a male. So one common pitfall I've seen a lot of people do. With that, on the top rows, obviously you can see that you have the state. So I just did Washington because that's where I'm at today. And then the product is custom. Most of the marketers you talk to here as far as mutual care solutions are going to recommend the custom. It's a lot more premium friendly, and it gives you a lot more options to play with. When you get over to the secure, it's going to be a lot more cookie cutter approach. The premiums are going to be a little bit higher. Still a great product, but it doesn't give you as much flexibility to kind of build and change things around. One thing that's important to always find out, whether you're doing these yourself or you're asking us to do a quote for you, is whether they're single or they have a partner. If they have a partner, we want to know if both of them are going to be insured or if one of them is going to be insured, because they get different levels of discounts, right? So if you have someone who's calling in and they're just getting it for themselves, it's still a good idea to find out if they have a partner, because even if just that person's getting it, they still get a bit of a discount. Obviously, you can pick the gender or sex here. For the age, you got a nice little drop down, or you can get a little bit more kind of, accurate and do their birth date. If you don't have it, no worries, right? As I mentioned, I always do select. One thing for the benefits, when it comes to a monthly benefit, I usually look for somewhere between the 5,000 to 7,000 range. Obviously, that's going to be adjusted based off the information you find out when you're talking to them, right? If you go ahead and click on this drop-down arrow next to the policy limit, it'll show you not only the policy limit amount, but as you can kind of see in that white box, it'll give you about how long that'll last if they're using the full monthly benefit. Most people do 3 years, kind of just what's the most popular option. Most popular for eliminations, around 90 days. Usually we leave that the same. If they're looking at wanting to kind of get that number smaller, normally what we recommend that's going to kind of have less of an effect on the premium as far as increasing it is doing the home health care waiver, right? So that's going to give them a 0-day wait on any home health care. Pretty simple. One thing that's really changed over the years is you will not see many people getting lifetime 5% inflation anymore. The reason for that is the costs jump up, an insane amount with really any inflation. A lot of times when I'm building these out, and everyone's a little bit different, but I usually try and get them inflation to around 70, 75, maybe 80. 3% is a pretty common number. You could go lower. So we'll just do 15 years on this one, right? And that's where we're at. The nice thing with this is based off what you're doing with the inflation, it's going to show you whether or not it qualifies for partnership. So you don't have to sit here and try and figure that out, right? 15 years, 3%, cool, qualifies for partnership. If we do no inflation, it doesn't qualify for partnership, right? Pretty simple. So we're just going to throw some inflation on there just because I want you guys to see something really quick. So this is a quick, simple run through. If you guys need more, right, we'll go through it. But like I said, we're trying to squeeze a lot in here pretty quickly. These are going to be some different riders, benefits you can add on there. Shared care is pretty popular. Survivorship's pretty cool. If you have any questions on some of these, you do have this guide up here that you can click on, right? And then you'll have the underwriting guide and the product guide. You can go through and read about it. If you don't want to read about it, give us a call. I'll tell you what they all are, right? So when you click preview, I just do select all, I hit OK, okay? And this is really quick, dirty, but going through it, you're going to be able to see what your premium is, which we already saw. It's going to break everything down, so you're going to have your illustration. One of the pages I like to go to really quick, and this is going to be kind of important, is I put inflation on this, right? So I like to see what it's actually going to build up to. So we're looking at about, just under $8,000. And that's going to not be there until 15 years from now. Another thing you can do is you hit copy current over here. This is going to allow you to have a second page of a quote that you can jump back and forth between, so that way you're not messing up your original quote, right? I'm going to go ahead and do no inflation, and I'm going to do about 8,000 for 3 years because that's about where it built up to after 15 years of inflation, just to see what the price is, right? So one thing to note is it's $279 to get $5,000 a month for about 3 years with the inflation. Like we saw, it's going to max out just under 8,000. Or they could start off at 8,000 for a tiny bit more. And then that way, if something happens, in a year, 2, 3 from now, they're starting off with a bigger benefit, right? So these are kind of some different approaches, right? This one's becoming a lot more popular, is front loading the monthly benefit and not having any inflation versus having inflation, because inflation's really expensive, right? And then if something does happen between now and the next 15 years, they're going to get more money in their monthly benefit up front. It's kind of an easier sell, especially when you present the two together. So that's a nice kind of approach to do it. Obviously, with this one, you can hit Save Client. You can have all your clients saved in there. You can jump back in there. You can email these quotes pretty easy, or illustrations. So that's going to kind of be the Mutual Care Custom Solutions. It's going to be a great product. It can be made very, very affordable. Check out some of our other webinars that go into a bit more detail on that. But it's going to be a pretty simple quoting tool, right? It's easy to jump into. It's easy to get the prices. And it's one of those things that everybody can kind of, do fairly simply. So I'm going to go ahead and jump over here. The next kind of easiest one to quote is One America. You can see the link up top. If you guys don't have this, we can send it to you, right? But this is kind of a nice, quick way to quote for One America that I use personally. You don't have to log in. You don't have to register. You're just in, out, really simple. So yes, I'm a financial professional, right? And then it's going to do a little bit of thinking. The asset care is obviously going to be their life hybrid. And then the annuity care is going to be the annuity hybrid. I'm just going to run through one of these because they're almost identical. Obviously, the product itself is not identical, but the way you fill it out and get the illustration is. So for the state, we'll just go ahead and do Washington, which will be all the way down here at the bottom. And we're going to do this for one person. We're going to say they're 40 years old, right? Obviously, the names are pretty simple. And once you've done one of these, they're going to be very similar for no matter who the carrier is, right? There'll be some little differences, as you're noticing, but a lot of it's going to be pretty identical, okay? As far as this product, so some of those state differences I was talking about, if you're doing this in California, there's not going to be an option to add inflation on the AOB or the initial benefit. Since we're doing Washington right now, it's going to let us. So obviously, you can do single premiums, you can do recurring premiums. Once you do recurring premiums, it's going to let you select, to what age you're paying. As far as this one, it won't let me change the initial benefit, right? So that's fine. I can go ahead and put inflation on this if I want to. Going through here, so the continuation of benefits and the way this policy works, if you're not familiar with it, is really quick. You're going to have your initial benefit, and let's say it is going to be $5,000 a month, okay? And basically what's going to happen is for 2 years, it's going to pay out $5,000 a month, and it's going to grow a little bit at 2% inflation that we have up here, so it could increase a little bit over time. And then what's going to happen is once that's gone, it's going to go into your continuation of benefits, right? So you can do this for 2 years, you can do it for 4, you can do it for 6. So essentially what that's doing is if we do 2 years, you're going to get $5,000 a month. We put some inflation in there, so it may be more, right? For 4 years, 2 years initially, 2 years after. The other popular option is lifetime. So no matter how long they are on claim, it is going to keep paying out. So that's a pretty popular option. Obviously, with that, the cost is going to be quite a bit more for their premium versus doing just 2 years because it could pay out indefinitely. Well, they'll pass eventually, but you know what I mean. It can pay out for a very, very long time. This is one of those things for people who are worried about, the money running out. Most claims on average don't go that long, but, some do. And when you look at the numbers of the average claim being about 3 years, it's hard to tell whether that's because a lot of people are passing before that, or simply because most of these policy types are built for 3 years and they're running out of funding, right? Maybe they would have kept staying on claim had they had the money to do that. So just some different options for what people are worried about, right? That kind of comes in, what are they hoping to get out of this? And then inflation duration. You can do it lifetime, you can do it 20 years, right, on the COB. So there's kind of some nice different options in there. Then you just hit calculate. It's going to give you kind of a quick overview of what's going on, what the cost is. These are going to be really popular options for people who don't want to have the traditional long-term care be use it or lose it, who don't want to have to worry about premiums possibly going up sometime in the future. This is kind of a really popular product because it is the most true hybrid as far as I'm familiar with, kind of out there, meaning it has really, really great long-term care benefits. A lot of other hybrids out there for the life side are more life-based, and they kind of have the long-term care as just a small rider or, add-on feature. There are some other really good ones out there, right? So I'm not just saying this is the only one. And we do have some of them, such as Nationwide and stuff like that, that are great as well. This is just a really popular option. From there, you just hit create PDF, right? And then it's going to throw up your illustration. So like I said, all these tools are pretty simple, right? Pretty easy to jump through and kind of go from there. This will pop up. You can save it, download it, email it. They look very nice and pretty. California's is a lot shorter, so doesn't have as many of these cool pictures and stuff like that, but you just go through, right? And this page is really important because this shows you kind of those initial benefits, then the continuation of benefits, how it's unlimited. It's going to show you all the fun numbers you need to run through with the client, right? So that's going to be the hybrid side of it. Like I said, very quick. This is to give you an overview so you guys can jump in there and kind of start testing the waters with these tools, seeing how they work, getting in there, right? And then if you get stuck or you just have questions, right, go ahead and ask us. I'm going to be doing a follow-up call after this. We can kind of jump through, set up a time to actually go through these in depth for all the different possibilities, okay? And then we're going to get to what I get the most requests on for illustrations, not only from you guys, the agents, but from fellow marketers, right? That's going to be the IULs. So pretty simple. This is just WinFlex, the dashboard quoting tool for mutual. You go ahead and click on illustrations. We'll see if it's going to be quick or not today for us. Because we do have a little bit to actually cover here on these ones. So, all right, you're just going to start a new case, Mutual of Omaha. As far as IULs, you're going to have two different options, right? You're going to have the income advantage IUL, and you're going to have the life protection. I get asked a lot about what the difference is on these. The simple answer is it's really in the name. So the income advantage is going to be based a little bit more on growing income over the kind of, life that they have this for. With that, the premiums are usually going to be a little bit higher than the life protection side, for what they're paying in, because the life protection is more just concerned about really building, right, a policy that's going to meet life insurance needs. Having said that, IULs are very flexible. You can kind of still build them however you want. But as far as getting stuck here, if you have someone who's more concerned about really growing cash value, probably go with the income advantage. If they're not as concerned, or if they're a little bit older, go with the life protection. The premium will be a little bit less, okay? So from there, you just hit create client. It's going to do some thinking for a little while. It should pop up with the screen to actually let us do some quotes. And the keyword there is should. There we go. Okay. So there's a few things you need to fill in to be able to actually get an illustration and send it out. I'm going to jump around on some of these different tabs up here, right? So the first and easiest thing to do is your agent info. You're just going to go in there and fill it out each time. One thing I'm going to recommend, if you're just an agent and you're only doing your own quotes, go ahead and save your information so that way you don't have to actually type it out each time, because it will not give you an illustration unless you fill in your information. If you're in California, you're going to have to actually put in your producer license number. It won't let you move forward without it. So that's one thing to kind of note. Right. And then this is just obviously AIMS information. If you guys need to get a hold of us, there you go. Right. And then we'll go back to the insured. So valued client, we're going to have a male. We'll say he's 45. Fine. Like I said, I always leave this at standard. If you have a client who's, persistent and they don't want to move forward unless you do it on preferred, fine. Just give them a little blurb of, hey, this could go up, right? We're going to do Washington just because that's where we live. Okay, so to start with, I'm going to show you the very simple way to go through this. Setting it up is just life insurance, right? This is going to be I want to get into IULs. I don't know much, but I like the idea of permanent life insurance for some of my clients, okay? Very simplistic. So you're going to fill out your agent info. You're going to put in their information. We're going to do solve for. This is part of where finding that, what their budget is going to be pretty big, right? Or what they're kind of hoping to have. Let's say they're trying to cover mortgage, right? Whatever the case is, or they just want to have something simple like 100K. And I'm just going to do this as $1 million just because it's going to show some numbers better here in a second, right? So go ahead, put in, let's say they want $1 million. We'll get into what these are in a second, but if you're just trying to do this as a very simple first run through, just leave it on solve for CV, right? That's solve for cash value. Like I said, we'll jump a bit more into that in a second, but this is going to be kind of that simple run through. Don't want to adjust a million things, gonna leave stuff where it's at, okay? All right, and then from there, disbursements, you're not gonna have to worry about any of that, right? Because we're not gonna touch that right now, we're just keeping it simple. Index strategy, you're not gonna touch anything on here right now. The biggest thing for this is it is going to default to the S&P 500 1 year 100% participation, okay? That's gonna be either in this case, what we're going to want to pick, right? Since we're not doing anything, or if you do start jumping into index strategies a little bit more and you want to kind of set something as a set it and leave it, it's going to be one of your best options, mainly because it's going to have some good returns. Even if the stock market has a couple down years or, the S&P, whatever, right? Most of the time it's going to have up years. You're going to be okay for that, right? So we're going to go ahead and just leave that alone for now. That's going to be your set it and forget it kind of stage there, okay? Policy options, and this is one thing you're going to adjust. So usually a lot of times death benefits are going to be preset to level. Just go ahead and leave that. If you're starting out really, really low at like 100K and they're 20 years old, I'd probably go ahead and change that to increasing so it goes up over time. But for now, this person was a little bit older, so we'll just leave it level. Going to help with the premium. BSP is the monthly one. Why they don't call it monthly, I don't know. So we'll put it on monthly. Always leave this checked. We'll go into what that means in a second. But like I said, right now, we're just doing the quick one. Riders, we're not going to do. And any of this other stuff for the quick run through, we're not going to do. And then you'll hit calculate. And it's going to think, and it's going to take some time, okay? One of the things with this kind of quoting software is it's a bit slower when it comes to calculating. So we're not going to calculate every single one of these, right? But I'm just going to show you, this is how simple this can be. You can go ahead and jump through this very, very quickly and make sure that you're giving them something that's, set up really well. So go ahead, do that. Like I said, this is very slow calculating. I'm just doing it this one time so I can kind of show you how to get back into the quote once it's done calculating, hopefully. Come on. There we go. So one nice thing with this is if anything's messed up or broken, you're going to get a little red exclamation here. You can click on it. It's going to tell you what's wrong, what you need to do to fix it. You'll just click on the client's name. That's going to take you back to being able to adjust the quote. If you're thinking everything's good, you just go ahead and click on this, download it, send it out. All right. So that's the simple way to jump through these and get someone a permanent life insurance that's going to be a good type of policy without having to adjust everything, right? You don't have to worry about, oh, I don't know if this is a good policy. I don't know if I built it right, right? A lot of the things that are set as the presets or that it just defaults to are going to be really strong options and they're going to be very well set up. One thing I will warn you never to do, and I shouldn't say never, 99.9% of the time not to do, right, is when you're looking at some of these different areas, and especially the solve for, under the different premium solve for types, you will see minimum premium. This is going to be the absolute minimum premium that a client can pay to kind of keep the policy in force for a while. A lot of times it'll be around 10 years, 15 years. And this is where a lot of agents start to get in trouble. And this is where a lot of clients have had bad experiences. So what agents will do is they'll be playing around with this or they'll be taught to do it with minimum premium because it's easier to sell something when it has a smaller premium, right? So they're still going to get that $1 million benefit, but they're going to be paying like half, and don't quote me on these percentages, but they'll be paying like half the premium they would be if they were doing it on solve for cash value, okay? And it looks a lot more attractive, right? But the problem is the policy is going to kind of cannibalize itself because they're not really putting enough money into it to fund it to keep it alive. The only time I'd recommend doing a minimum premium is, let's say you have a lawyer or a doctor, it is their last year in, med school or for them getting their law degree, right? And they're going to come out making a lot more money. And then you need to prep them on the fact that you really want to start paying X amount next year. But they really see this need to have this bigger policy now. So it's a very limited use that I'd actually recommend it for. For 99% of it, just never touch it, right? No matter what you're doing. Solve for cash value is really going to be the approach that is going to build the most cash, right, over time. It's going in there and it is looking at, okay, this is the premium they need to pay to really grow some good cash value. So that's one way to do it. Another one is the no lapse guarantee. This is going to be, the premium they have to pay. And a lot of times it's less than the cash value because it's not really concerned about growing cash. It's concerned about just keeping a life insurance policy in place. So the premium is usually going to be a little bit smaller. But it's actually going to keep this in force, right? So maybe for 80 years, 90 years, 100 years, right? It's going to ensure that they're paying enough to actually keep it in force. So that's another option you can use, right? Another one that's pretty kind of, popular besides cash value is going to be target premium. So this is going to be kind of that middle ground between the no lapse guarantee and the cash value, right? It's going to grow a little bit of cash value, but not as much. It's not going to be as expensive as cash value on the premium, the solve for cash value. So it's a good kind of strong option where if you're like, they don't really care about cash value too much, but it's kind of a nice option, they want it, I would do the target premium, right? That's a really strong one. When you have someone who's coming into this and they're trying to build it as, an annuity, basically to mimic that, you're going to want to go with the TAM or 7 pay, right? That's going to be 7 payments, right? Of not 7 payments. If they're paying annually, it'd be 7 payments, but 7 years of payments, okay? Really important thing on there right, that is really going to help grow. This realistically will build more cash value than the cash value option, but not everybody can really afford to get all the payments out of the way in 7 years. This is going to be for those more affluent clients, those who are really looking to build cash value, and it's going to be a really great option for that. One nice thing with this, and I will show you in a few seconds, is actually, let's just do it now because we don't have time for everything to sync and download. But what I would do is if you're doing a TAMRA 7 pay, right, go ahead and do year age to pay a premium, click year, and do it at 7. What you'll see when you do these, if you don't do that and you just do TAMRA 7 pay, when you look at the illustration, it'll stop paying at 7 years, and then like around year 20 or 25, it's going to want them to pay some premium again to kind of help, shore things up. A lot of times you don't even need to do that. So what this does is this lets you stop paying either at a certain year or age. So it's kind of a fun thing to put in there. Another time I use this a lot is, let's say we have someone who's 35, they're thinking they're going to retire at 60. I'll have this stop at age 60, right? Because nobody wants to pay premiums on life insurance when they're 60 years old. With that, you're going to want to look at the illustration, which we'll do here in a second, right? And make sure it's good. So this is going to be the TAMRA 7 pay. As far as disbursements, we're not going to get too much into that now, but if you are building these to mimic an annuity, you can go in there, you can go ahead and say, okay, at age 55, we're going to start taking out $10,000 a year, and it'll build that into the illustration for you so you can make sure you're not going to run out of money or cannibalize the product. One thing a lot of people will point out is these premiums are locked into a point. So if someone borrows a lot of money from them, they're going to either have to pay it back or increase their premiums to make sure that it doesn't run out of money. But the premium itself doesn't technically change, right? It's just if they borrow or take stuff or different things like that. As far as index strategies, okay, so we do have a few different options here. For most agents, unless you really want to be in there adjusting stuff every year or month, or your client's going to do it, I recommend just leaving it on the S&P 500 1 year, right? That's going to be your set it and forget it. If you have someone who is very scared, let's say like right now of a recession coming, they don't know what's going to happen, you can go ahead and do a fixed account, right? It's going to give them a guaranteed percentage, in this case 3.5%, and it is going to pay that out every time. Part of the reason why I say if you don't want to be in here all the time, just leave it on the default, is because let's say we set someone up on a fixed account right now because we're scared, markets are going to be going down. They rebound next year or in a few months. We're going to be losing a lot of cash value growth for them compared to some of these other options, right? Because it's going to be capped, it's guaranteed at 3.5. The other things on this that a lot of people are curious about what they mean are going to be the participation rate, right? Basically, that just means that's what's actually going to go towards your cash value. So let's say you're sitting here, you have, what's a good example that would kind of make this easy? Let's say something goes up, 7%, right? And you're at 100% participation rate. It's going to credit 7% towards, right, that cash value, what's growing. If it's capped at 50, right, and it goes up 10%, it's only going to put 5% towards it, right? So that's kind of what's going to pay out towards it. It's good to note that when you're selecting these, they're all going to have different kind of pros and cons of what's going on, as far as what's going to be credited interest and different things like that, and market kind of predictions. And I don't want to go too deep into that with this because we can spend a lot of time just on that. That's really kind of the basics to take away from this are, is there a cap? What is it? And how's it actually going to be crediting that interest towards the cash value? Hence why I said this option that it just defaults to, the most common, it's the easiest to put there. It's still going to give them some really good returns, and it's going to be actually crediting a decent amount towards it. The other thing to note with this is all of these are going to have a floor of 0%, right? So even if the stock market completely crashes for a year or two and there's negative returns in the real stock market, they're going to be getting 0%. So pretty safe, pretty easy to leave it at, really good thing to do. The reason you're leaving this alone is what this is going to do is make sure that this does not become a modified endowment contract. So when a lot of people are buying these and they're looking at growing cash value, right, they're doing that because there's a lot of great tax benefits that come from life insurance policies. Having said that, the kind of test they use for these by the IRS is to make sure that this is still life insurance and it's not just an investment, right? Because if it's just an investment, they are going to tax it as an investment. You're going to lose all those fun tax advantages of life insurance, okay? So a couple of the ways they do this as far as testing whether something is a modified endowment contract are there's a few different tests. One of which is the TAMR 7 pay. So they're making sure that the maximum premiums you pay in over 7 years, right, is the right amount. So when they're looking at it, they want to make sure that you're not putting in too much funding too aggressively, because then they're like, okay, this isn't life insurance, right? This is an investment. So they're not going to let you get away with that, right? So one nice thing is this is kind of built in there. You don't have to really worry about what the tests are, what they look for, what they mean. It's going to do it for you. One of the other tests is basically just going to be, when they're looking at what's going on, there's the CVAT, which is the cash value accumulation test. It's just making sure the cash value isn't growing too quickly compared to the death benefit. Sometimes you can adjust that by doing an increasing death benefit. That'll kind of help level things out. So if you're running into an issue, that might do it. There's the GPT test, which is really just kind of looking at the premium to death benefit ratios, right? So all these different tests are in there. The 7 pay is kind of the most common. One thing to note is that the life protection advantage is really running based off of the severed TAM. Can't even talk anymore. The 7 pay. So when you switch over to the income advantage, if you build this based off of solve for a 7 pay, you're going to get a red exclamation, and you're going to see that it's not paying the same amounts each year for premiums for those first 7 years. So if you really do want to do a TAMR 7 pay, I recommend building it in the life protection advantage. I know that's a little contradictory to, like I said, this isn't going to grow as much cash, but in this case, you do want to build it in the life protection for the TAMR 7 pay. So it's going to be really important. As far as riders, to add or remove them, you're going to have to click this before it'll let you click any of these, right? So that's something to kind of keep an eye on. These AIR selfs and AIR others. So I said to leave those alone earlier. They are really fun things. So basically what this is going to do for the self is it's going to allow you to really kind of build in a term policy. So you don't have to do a separate term and IUL. You can build it into this, and you can do it to a certain age. You can do it for a certain amount, right? You can only go up to the face value. So if you're at $1 million, you can't put this at $2 million. If they need $2 million for a term, you would have to do a separate policy. Obviously, AIR other, right, is if you want to build a term policy into this for somebody else, right? So maybe your spouse or whatever the case is. Keeps it pretty simple as far as what's in there. Obviously, it's going to adjust the premium because you're adding more life insurance, but it's a cool way to have only one policy for somebody that is both permanent and term. As far as reports and concepts, honestly, just leave those alone for now. Like I said, we don't have 4 hours to go through this, but leave it where it's at. As far as calculations and when you're looking at these illustrations and whether or not you did things correctly, there's a couple places I would look. One that's popping up. So when you actually get this to come up, okay, if it'll do it, come on. You basically want to pull up the illustration, and you are going to jump down and look at a couple things whenever you build an IUL. So the first thing is going to be page 2. It's going to just make sure you did everything right. So we got $1 million. We got our initial premium. Okay, cool. Right. And then you're going to go ahead and jump down. And this will vary a little bit based on exactly what page it is, based off of, if you put riders in there, different options. If you haven't read through one of these, I would. There is a lot of good information up there. But for me, I usually jump down here to this page. Okay. So the nice thing with this is it's going to kind of show you based off of the last, I believe it's 20, 25 years of the market, what things have been growing at per average and what they have, right? For our index that we selected. And then it's going to give you 3 different columns, which are kind of fun. So this far left is the guaranteed amount. It's going to be at 0%. So if the stock market paid back at 0%, this is how things would grow and last. As you can see, it runs out of money at age 82, 83. This is one of the most common questions I get when going through this with clients is, what's going on? Where's our money? What happened? I usually, and it's not a joke, but it's a little bit of humor to it, right? Like to say that this is the worst case possible solution. This is basically things are going into anarchy. Our economy collapsed, right? Because this is saying that this is going to pay back at 0%, not just for 1 or 2 years, but for multiple years. So in this case, it's paying back at 0% for 35 years, right? If we have our markets paying back at 0% or less for 35 years, our dollar is going to be worthless. It doesn't matter where it's at, right? Our economy is dead, right? The what your life insurance policy is going to be the least of your worries at that point, right? So this is realistically probably never going to happen unless we are in a doomsday apocalypse situation or our country just completely defaults and goes away. Now, it is possible to pay 0% every once in a while, right? That's a common thing. But for it to happen that many years in a row, probably never going to happen, right? You never want to guarantee that because who knows, right? But this middle column is 3.5%. So that should probably stand out because that was that guaranteed amount. That's what you're going to see in a lot of whole life policies is their guaranteed amount that they're paying out. This is a really safe bet, right? If Mutual is able to guarantee a return of 3.5%, it means that they really probably shouldn't ever get below this. Obviously, you don't want to guarantee that, but this is a really, really safe bet of what's going to happen, okay? And then on this far right is 5.56% right now. This is what they've actually been growing at the last 20, 25 years. So even this is a really safe bet. It's not like where it used to be where they put like 9% here and be like, hey, this is what you could get, but it never actually returns at that. I mean, maybe a year here or there, but not on average, right? This is their average going back quite a bit. And that includes, right, the recession. That includes COVID. That includes all these big, huge dips in the market. And it's still returning at that over that length of period. So still a pretty safe bet. Normally what I tell people is realistically, they're probably going to see numbers somewhere between these two. And sorry, I didn't say it, but your far right column is your death benefit. This middle is the cash surrender value. And then this is your accumulation value, right? So you're kind of looking in this middle one, how the cash is building and that surrender value. One thing to note too, like I said, I did cut this off at 7 years. So the last time they're going to pay any premium is at year 7. When you go down past that, it's 0, right? So with this, it's a really strong illustration and proposal because as you can see, even though they stop paying, these cash values in the middle keep growing. They keep getting bigger, right? And this is where this gets kind of fun, especially if they're trying to use this to mimic an annuity, is starting at age 60, we'll start taking out some money, and that'll build that into this illustration for you. And you can make sure you're not wiping this out. If these columns over here and not so much the middle one, because like I said, that should still be a pretty safe bet. It should be somewhere between here. But especially if this right column ever starts going down to zero at, a younger age at like 50, 60, you need to go back and change something. You're probably on minimum premium, or it's being very underfunded somehow, or if you're having them take loans out, you're taking out too much loans. That's when you have to stop and say, okay, this policy is going to eat itself alive. That's when a client's going to come back angry if I'm getting a cancellation notice or I need to pay more money. And that's a really kind of safe way to double check and make sure you're building it correctly. Is jump in your illustration, and if these numbers keep going up, right, you're pretty safe, right? It shouldn't go away anywhere unless we have some kind of cataclysmic event that just completely, takes us out. From there, you can save it, you can send it, you can go back over here, jump back in, make any changes you need to make, right? That kind of thing. So simple run through, a little bit more in depth than we usually do on any of these. So hopefully there's something you can go in there and kind of adjust and play around with and get an idea. I recommend doing either a valued client or on yourself and just kind of going in and checking the illustrations after you change some stuff around and see what happens with some of those options we talked about, right? Kind of wrapping stuff up a little bit, offering solutions, not products. Right. So like we talked about, not only do you want to be on the same page with them, get them thinking the same thing, right? You're trying to get them to the end goal of what they really want, right? In this case, the mouse wants the cheese, right? And our job is to kind of guide them through this maze of misinformation, of what they think they want, right? Because we're the experts. We should know what's going to best suit what they say they want in that end goal, and to get there together and walk them through it. And it's a lot easier when you can identify their fears or needs. Not that we're trying to feed off their fears, right? But we're trying to give peace of mind for what they're worried about, right? And then we can say, I have a solution for that, right? Not I have a product, I have this, right? And it's really going to just kind of help build that with them and get there. So when you're going through all this, right, there's a process to keep the conversation on track, to get the information that you really want and need to be able to work up a good quote. Because they may come in there saying they need permanent life insurance when really they need a term. They may come in there saying they need term when they need permanent. Or for a lot of cases, and a lot of times what I do is a mixture of both. I'll do term to take care of something like a mortgage and their big debts that should hopefully go away over 30 years, and do a smaller IUL of 100, 200K so they have permanent life insurance that's affordable for their whole lives, so they don't end up in a situation like my mom, who's, not able to qualify for any life insurance now, and her term policy is past its term, and the premiums just keep jumping up and up and up, but they need it, so they're paying it, right? It's just one of those things where it's a good solution, right? And not just accepting what they say when they call in right away, right? I need this. Okay, cool. I'll give you a term buy, right? Because one, you might be leaving a lot of premium and commissions on the table. Two, it may not be actually fitting their needs of what they need. And most of them won't, but some of them might come back if one of them passes away and it doesn't cover anything. Like, hey, why didn't you have this conversation with my wife? Why didn't you tell me this? Blah, 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 right? So that's something to put there, right? And then really, like I said, just go in there and play around with the tools. If you want to set up a time to talk and walk the room with me or some other marketer in here, we can do that, right? We can make sure you know what all this stuff means and what it does and how to adjust it more in depth than we did here. And it's really just the familiarity of getting in there and adjusting things. And the nice part is, like you saw, you can keep IULs very, very simple, right? It's almost like doing a term quote, right? But you're giving them permanent life insurance. So they do make it not fail-proof, but pretty user-friendly. And then you can go crazy in there and you can build college savings plans and mimic annuities, and you can actually go in and play with different options as far as investment strategies and adjusting them. Like I said, I don't recommend doing that too much unless your client really wants it, because you're going to keep yourself really busy with complaints or them checking in all the time of, oh, the market's doing this. Did you change this? What's going on? What do we have our investment strategy as, right? And that will tie up a lot of time I myself, probably 80% of the time, just let it default to that S&P that it stays at for the 100% participation. Um, so that's where I'd really recommend most of you leave it at. You can, if you have someone who's very savvy and wants to do the investment side, tell them about it, because they are able to go in there and on a monthly basis they can change the new premiums coming in that's going towards that side of it, towards new strategies and different things in there. But unless you really want to get into that financial advisor investment strategy side, I would shy away from it a little bit, right? And not get too in depth with it, because you don't need to, right? There is a set it and leave it option, which is what it defaults to. So with that, we did run a little bit over. We crammed a lot of material in there very quickly. So if you do have any questions, shoot me an email, give us a call. Like I said, I will be reaching out to you guys for follow-ups to see if you had some kind of other questions you didn't ask. We did get a few questions, but they're a little bit more individualized or in depth. And, I don't want to be here for 2 hours and have you guys sitting through all that. So thanks again for being here. Look forward to speaking to all of you, and I hope you have a great day. Thank you.